Ford Motor Company is grappling with the declining stock price, mounting financial issues, and significant losses in its electric vehicle division. Amidst quality control problems and fierce competition from global automakers, including Chinese and Japanese rivals, everyone is wondering, is Ford heading towards bankruptcy? Stay tuned to find out if Ford can turn things around or faces deeper trouble. Ford's performance 2024. Ford's electric vehicle division reported a significant $1.3 billion loss in the first quarter of 2024, translating to a staggering $132,000 loss per vehicle sold. Ford's EV division, known as Model E, sold 10,000 vehicles in the first quarter, a 20% drop compared to the same period last year. Revenue also plummeted by 84% to approximately $100 million, largely due to industry-wide price cuts on EVs. Consequently, this led to a $1.3 billion loss before interest and taxes (EBIT) for the Model E unit, marking a substantial loss per vehicle. The losses weren't limited to just the cost of producing and selling these vehicles. Ford clarified that a significant portion of the loss stemmed from heavy investments in research and development for future EV models, investments that won't pay off for several years. As a result, Ford anticipated further losses from the Model E unit, projecting a $5 billion EBIT loss for the entire year. The company aimed to have EV prices reflect the actual production cost within the next 12 months, excluding R&D expenses. However, Ford CFO John Lawler acknowledged that ongoing price wars in the EV market have made achieving even basic profitability challenging. For instance, while Ford managed to reduce costs by $5,000 per Mustang Mach-E, revenue was declining faster than these cost savings. Despite the challenges in the EV segment, Ford CEO Jim Farley assured investors that the company was making strategic adjustments and expected the next generation of EVs to turn profitable in the near future. Now, while Model E struggled, Ford Pro, which mainly sells traditional internal combustion vehicles, was the company's main profit driver in the first quarter with an EBIT of $3 billion, more than double from the previous year, thanks to a 36% rise in revenue. Vehicle sales in this division increased by 21% to 409,000 units. On the other hand, Ford Blue, responsible for selling gasoline-powered cars to consumers, saw an 11% drop in sales to 626,000 units, with revenue falling by 13% to $21 billion. This resulted in a nearly two-thirds reduction in EBIT, down to $905 million. Together, Ford Blue and Ford Pro generated profits similar to the previous year, but the growing losses in the Model E division led to a 20% decline in Ford's overall net income, which fell to $1.3 billion. Adjusted earnings per share dropped 21% to 49 cents, though this was slightly better than the expected 44 cents per share. Meanwhile, during the same period, Ford's competitor, General Motors, announced that its North American EV business was on track to become profitable in the second half of the year. Stellantis, which manufactures vehicles under brands like Jeep and Dodge, reported that its European EV operations were already profitable last year. This left many investors wondering what exactly was going on with Ford. Now, to add to its troubles, the second quarter results also came out disappointing for the company. Ford's second quarter result. Ford Motor Company is once again grappling with disappointing second quarter results, which, along with a lukewarm industry outlook for the remainder of the year, have led to a more than 20% drop in its stock value. Ford's second quarter earnings were a major letdown, with the company reporting a net income of $1.87 billion, slightly down from $1.92 billion in the same quarter last year. Earnings per share came in at 47 cents, falling well short of the 68 cents expected by analysts. However, the company's overall auto revenue exceeded expectations, totaling $44.81 billion. One of the primary factors behind Ford's underwhelming earnings in this quarter was the need to set aside reserves for warranty issues. According to CFO John Lawler, while the company is making strides in improving quality, the warranty concerns, particularly for vehicles manufactured in 2021 and earlier, remain a persistent problem. Given the volume of cars Ford produces each year, these quality control issues could continue to plague the company for some time. One of the most prominent issues has been related to the power-shift dual-clutch transmission used in certain Ford Focus and Fiesta models. This transmission system, introduced with the promise of improved fuel efficiency and performance, quickly became a source of frustration for consumers due to its reliability problems. Customers reported issues such as shuddering, slipping, and unexpected shifts, leading to a high number of warranty claims and, eventually, class action lawsuits. Ford's handling of this situation included delayed recalls and insufficient repairs, further damaging consumer trust. Additionally, Ford has encountered problems with its EcoBoost engines, particularly in the 1.6-liter and 2-liter variants. Some of these engines were prone to overheating, leading to engine fires and other severe issues. These defects resulted in costly recalls and repairs under warranty, further straining Ford's resources. This has put pressure on the company's profitability and strained its relationship with suppliers and dealers. Moreover, frequent recalls and quality problems have tarnished Ford's brand image, making it more difficult for the company to compete in a market where consumers increasingly value reliability. Another significant challenge for Ford is its electric vehicle division, which was also the main source of trouble in the first quarter. Despite a 61% year-over-year increase in electric vehicle sales during the second quarter, the division posted a substantial loss of $1.14 billion. The combination of high costs and weaker-than-expected demand has created a difficult situation for Ford. Although the company remains the second-largest EV seller after Tesla, the financial losses in this segment are casting a shadow over what was expected to be a key growth area for the company. Given these challenges, coupled with a tepid industry forecast for the second half of the year, Ford shares may struggle to deliver strong returns for investors throughout 2024. Now, before we see how Chinese and Japanese manufacturers are threatening to kick Ford out of the market, please hit that like button and subscribe for more updates. Let's continue. Challenges in the industry. One of the biggest challenges for any automaker, including Ford, is that their stocks generally trade at relatively low earnings multiples, typically around 10 to 12 times earnings. This means that any disappointment in performance can quickly translate into significant downward pressure on the stock. Ford's lackluster second quarter earnings, followed by a more than 20% drop in its share price, is a clear example of this trend. U.S. auto sales, which are crucial for Ford's success, are expected to decline in the second half of the year, according to research from Cox Automotive. As inventories grow, automakers are increasingly offering incentives to encourage vehicle sales, almost like giving away cars, which could lead to lower prices. This shift marks a departure from the high prices seen in recent years, making it more challenging for Ford to achieve top-line growth. For Ford stock to regain momentum, the company will need to deliver positive surprises in the second half of the year. Merely meeting expectations won't be enough, and given the current outlook, Ford may even go bankrupt if it keeps up with this performance. Ford Motor Company investors have been facing a series of hurdles lately. The company has led the U.S. industry in recalls for 3 consecutive years. It's been facing intensifying competition in the electric vehicle market, especially from emerging Chinese EV manufacturers, and now a new alliance of Japanese automakers is aiming to strengthen their global EV position. The rise of well-funded Chinese EV companies that produce high-quality vehicles with global expansion ambitions has been a growing concern among investors. And governments and global automakers are taking this Chinese ambition seriously. For example, Europe has introduced significant tariffs to protect its domestic automakers while they work to reduce prices and costs to a more competitive level. The United States is also considering similar tariffs, though there's a possibility that Chinese EV makers might circumvent these by producing vehicles in Mexico, depending on future policy shifts and the outcome of the upcoming presidential election. However, a new challenge has emerged with the formation of a recent alliance among Japanese automakers. Nissan, Honda, and Mitsubishi Motors have joined forces to develop next-generation EVs equipped with enhanced software, aiming to challenge both Tesla and the new low-cost competitors from China. Currently, US EVs are priced at nearly double that of Chinese models, partly due to government subsidies in China. In 2023, China was responsible for nearly 62% of the 10.4 million battery-powered EVs produced globally. Nissan and Honda are focusing on creating a joint software operating system with plans to bring it to mass production after 2027. The alliance will immediately begin working on electric motors, inverters, and eventually e-axles. By the end of the decade, the goal is to develop standardized EV batteries that can be used interchangeably across the company's brands. The Japanese automakers are also examining how to manage supplies between companies and have agreed on specific models to jointly supply in certain regions, which will help increase sales and reduce costs. Honda CEO Toshihiro Mibe emphasized the urgency of this collaboration, stating that companies that fail to adapt to these challenges won't survive. He described the alliance as a strong weapon in the competitive EV market. This alliance should not be underestimated, as the development of software operating systems for EVs is crucial for competing with the technological advancements made by Chinese automakers. These systems require significant financial investment, costing billions of dollars, and will be vital in the ongoing battle for EV market dominance. Ford's upcoming response. While Ford may not have the same alliances with other Detroit automakers, the company isn't unprepared to face competition from Japanese alliances or the expanding influence of Chinese EV makers. In a strategic move that now seems particularly astute, Ford has quietly been developing significantly less expensive EVs over the past 2 years. What began as a small, independent team of top engineers has grown in scope and importance within the company. Ford aims to launch its first vehicle built on this low-cost platform as early as 2026, targeting a price point of around $25,000. This price is well below the threshold that analysts believe could unlock access to mainstream consumers and accelerate the adoption of EVs on a larger scale. However, for long-term Ford investors, these international threats should be taken seriously. The company's management must successfully execute the development and rollout of this lower-cost EV platform swiftly, all while managing its traditional automotive business, a growing Ford Pro division, and ongoing quality control issues. Although there's no need for investors to panic, it is crucial to closely monitor these overseas developments. The next 2 years could be pivotal for Ford's near-term growth and profitability in the EV market. So, what are your thoughts on Ford's strategy? Do you think they can stay ahead in the EV race? Let us know in the comments below. Until next time, stay tuned and drive safe.